morning, everyone, and welcome to our industrials panel today. We have Les Wulf, Chairman of AIP Realty Trust, who's going to be logging back in, hopefully with sound in a second. Samir Manji, CEO of Artis REIT. Brian Paul, CEO of Dream Industrial REIT. Teresa Neto, CFO of Granite REIT. Kelly Hanczyk, CEO of Nexus Industrial REIT. And Gord Lawlor, CFO of PROREIT. Over the past number of years, we've really seen a significant increase in the interest and demand for industrial space or just exposure to the industrial sector. This has seen massive inflows into the capital into the space. 6 panelists here today have all dealt with this demand and capital inflow in their own ways. Some have been pure plays from inception, and some have opted for greater exposure to the industrial subsector. So starting with Kelly, who's made maybe the largest shift to the point of even changing his REIT's name, can you give us a sense of your thought process in that regard, how you would characterize the financial impact of the decision to really move farther into the industrial space so far?
Yeah, we made the decision a few years back when we had an opportunity in London, Ontario to capitalize on a pretty transaction for Class units of the REIT, so using our own equity to fund the transaction. So when we looked at it, there was really only one competitor in Canada as a pure play industrial. Everybody else is either in the States or in Europe. So we looked at it as a good move, solid move to put more competition, I guess, in the capital markets with really us and Summit as the pure plays. And we saw what we saw at the time when we did the London transaction. We had a big delta, I think, in what rents were in place there versus what they were going to. So the fundamentals in the overall industrial sector were just turning at that time, which turned out to be a pretty opportunistic time to convert. Our history had always been industrial. We made a few strategic moves to go to diversified. And then once we did that, we went straight back to industrial to get bigger in size and scale, so which we've managed to do. So it was pretty opportunistic, but it also was, the timing was impeccable because the industrial sector took off. And what we're seeing now is I guess the end result. We're seeing renewals that are 30 to 75% above a lot of our in-place rents. So for us, the financial impact really go up in the third, fourth quarter of this year and next year, where we're going to really be driving same growth. So
smartphone connected.
A huge growth for us. Yeah. Plus vacant land, which we're going to be able.
Anything that's plugged into your?
Yeah, that was distracting. But yeah, so our next year and a half should really reap the benefits of the move to industrial. So we are driving towards that pure play where we have assets for sale on the retail and office side, where we'll kind of gauge the market of what's going on right now, because I think there's a little bit of a disconnect of what's going on. So for us, it's a great move, and we look forward to the next year and a half of really driving our results.
Fantastic. So, Gord, I think it's safe to say that PROREIT's seeing those same tailwinds and as really drastically moved into the direction of industrial as well. Maybe you can talk about kind of PROREIT's move and how you see that going forward.
Sure. So thanks, and hello everyone. Yeah, I mean, similar to Kelly, we've been industrial focused the last several years, last 3 or 4 years. And that's just been driven by, as already mentioned, the potential upside in the rents compared to the other piece of the diversified sector. Diversified for us is grocery, pharmacy anchored retail. And then we do have a small suburban office portfolio and one downtown office asset. But when we started the REIT back in 2013, our goal was to have basically a diversified, however, with the growth in industrial and not so much office focused. I mean, we started with pharmacy, grocery anchored retail, and it served us well. It's just the opportunity for increased rents is, as Kelly mentioned, absolutely there. And we're seeing that in our portfolio toward the end of this year, and you'll see it in the cash flow beginning in the next 6 months of next year as well. So a little different. We just said we're industrial focused. We haven't put, our retail up for sale. It's still performing well. And the grocery, pharmacy, anchor retail that we have, performs a lot like small bay industrial that way. No significant tenant inducements or leasing costs or anything of that sort. And like I said, our office is just 6% of our portfolio at this point in time. So we don't have a need to do anything drastic with the rest of our portfolio because it's performing. But that said, we're industrial focused here for sure.
Perfect. Samir, I guess, really your Artis REIT has had more absolute change and movement than almost anybody else in the Canadian sphere, and certainly has, a lot of focus into the industrial side. Could you talk a little bit about, the REIT's goals and what it's looking at in terms of that industrial move as well?
Sure. Thank you for hosting this panel this morning. From a just macro perspective, I would start by saying for Artis REIT, a lot of our focus really, insofar as investment decision making, including within industrial, is being driven by capital allocation and where do we see in the medium to longer term the best opportunities to allocate capital. We have been on a net basis reducing our exposure with industrial through the monetization of some of our assets. We had a large transaction last summer when we sold our GTA industrial at what was then a record-breaking price per square foot. But as I think will be a common theme through today's panel, we're continuing to see in our remaining 8 million plus square feet of industrial across various markets in North America, a strong net absorption, including in Q1 across all markets, strong rental growth across all markets, and strong growth in value per square foot insofar as what's happening on the transactional front. And we will look to harness that on an opportunistic basis where it makes sense, so as to continue, again, from an overall capital allocation standpoint, to make appropriate decisions.
That's actually funny, because that was moving into my next question, which was, kind of be looking at the opportunistic and decreasing your exposure and taking expensive assets off the table and, doing dispositions. What is your thoughts on your net exposure to the sector? Is something where you're going to recycle assets back in, add in new industrial, or is it industrial is exceptionally expensive in some cases, and take that money off the table and put it to work somewhere else?
Well, we have three larger size developments underway in Minneapolis, Houston, and Metro Phoenix, over 1 million square feet. And as I'm sure is the case again with my peers on the panel here, we're seeing, at least in terms of historical basis, these projects have been underway for over 12 months. The appreciation or escalation in rents per square foot in those markets is going to produce, at the end of it all, a very healthy yield on cost. And I think even with escalating or inflationary pricing, generally, given the demand we're seeing for industrial, one can still pencil new developments in most markets today at a positive delta between what transactions are suggesting the value is in the market on completion relative to the yield on cost. And then the last point I'll make, I think if what we're seeing in the broader markets continues, I'm happy to sell my assets and allocate some of that capital to buy units in Dream Industrial, Granite, Nexus, etc., because these are great companies with great management teams, great platforms, great portfolios that are trading well below what the intrinsic value of their portfolios suggests.
Perfect. So Teresa, I know Granite sold some assets as well. I mean, you're certainly not changing your exposure to the sector, but you are moving capital around. So could you talk to a little bit of what you're looking at there and why?
Yeah, well, for Granite, we, in the last 2 years, we've really pulled out of our non-core markets, and those were kind of our single assets sitting in, European countries where we had one-offs. And so we've pulled out of the UK now, Spain and Poland and Czechoslovakia. So we're really down to the three core markets in Europe, which is Austria, simply because of our origination with Magna, presence there, and then Germany and Netherlands, which is our focus for Europe. And then US and Canada. And in US, what we have been doing, frankly, since, really 2018 is pulling out of exposure to the Magna assets. In the US, we've pulled out almost entirely. I think we have one left in the US. And that's really moving out of the manufactured base type of industrial type assets and transferring into the e-commerce modern distribution warehouse product. So that's really the transformation that we've been looking at. And so dispositions going forward, I think we're pretty well done on the non-core disposition front. And so now it's going to be selective dispositions and maybe in markets where we think we're, full, or, looking at product where the relative growth may be less than, putting capital elsewhere, which right now, as you know, we're focusing far more on development as opposed to stabilized assets at this point in time.
And I mean, that kind of, you touched on the distribution facility. And I think that's one of the things people are looking at, Amazon announcing, that they're going to be a little bit more conservative in the sector. So, maybe thinking with Paul, what's your 30,000 foot kind of scenario for 22, 23, and is that changing because of some, more conservative of the really large big box, or is it staying the same?
Mm-hmm. Yeah, thanks, Rob. Appreciate you hosting. Samir, we would love your investment. We need significant, well-heeled, long-term investors like you to invest at a time when we're at a bargain price. So we would welcome that, and it's good to be here with everybody. Similar to Teresa, we're doing a lot of development right now, and I do agree with some of Samir's comments that the opportunity in development is one of the more attractive ones right now. When you look at inflation, it is certainly affecting land, labor, and material, all the components that go into development, but it's also affecting rents. So we're finding that we can maintain spreads in new development. We're doing that in Toronto. With the large sovereign wealth fund that we've partnered with. We're doing that on the REIT's own balance sheet in Calgary. We're doing it through a fund in the United States where we're doing development in many markets, including Las Vegas, which has been a really strong growth market that serves all of California. Europe, we're also doing some intensification where we're adding square footage or adding density to properties that we already own. So that's a strategic initiative for us. What we find is that the markets we're in, Rob, are very, very healthy. The Amazon news is certainly getting a lot of headlines, but I think it's specific to some certain markets, primarily in the US. We haven't seen what they're necessarily doing or any sublease in Canada. I think they have a total of 19 million square feet in Canada, which represents about 1% of the total market in Canada. The markets that we're in are less than 1% vacant, very, very healthy. And so what we see is quite a long runway of rent growth in our primary markets. And the majority of our space is in Toronto, kind of the Golden Horseshoe area in Montreal. And what we're finding is that we are able to continue to push rents as replacement cost continues to go up. So there's some choppiness in the market. There's some headlines like Amazon. We don't see e-commerce really slowing down, and the Amazon news is not necessarily a reflection of all of the e-commerce business or 3PL business or logistics business. So we find the markets that we're in are still quite healthy, and the impact of that Amazon news is much less in Europe and in Canada.
Perfect. And then, pivoting right from the big box, high headline news to the small light industrial. Les, how bullish are you on this sector? I mean, obviously it's the polar opposite subsector, but is still within the space and has a different demand profile.
Yeah, the niche that we're falling into is small bay light industrial flex. And when I say small, anywhere from 1,800 square feet to call it 3,000 square foot units in a multi-flex facility. And by locating them in what we call infill sites, so they're established communities, we're seeing very robust the demand from small businesses and trades and services. The asset class was designed for trades and services, so it has a multiple components to it, which also includes secured parking for the rolling stock for the trades and services, which is very accretive to our rental because we charge separately for the rental. But the demand, and we're in Dallas and soon to be in Austin, San Antonio, Houston as we expand across the Sun Belts. But the demand right now is overwhelming, and it hasn't slowed down in Texas. Part of that is driven by the migration. 38% of our inquiries come from people that are migrating businesses from California, Illinois, and the Northeast. So we see a great demand for the small businesses and trades and services. Development costs are starting to level down from the coming out of the pandemic highs, and a very robust development pipeline. Rents are increasing as a factor of supply and demand, but we're very bullish on the space for the light industrial.
Wonderful. And then Gord, kind of going back to the Canadian focus, what are you seeing in the industrial markets in your target areas?
Yeah, so I mean, we bought about 300 million in assets in 2021. So that was a small bay portfolio in Winnipeg, 3 assets in Ottawa, and then a good sized portfolio in Halifax, which is largely small bay. So we're, Halifax, $6-7 rents, moving to $9.50 to $10 right now. So we're very pleased with what's going on in that market. I'm originally from there, and you look in the north end of Halifax and you see 5 cranes there building condos and residential, and that's largely all supplied by the Burnside Industrial Park, the cabinet makers, the flooring, all those types of things. So that piece in and of itself, Halifax is just a good bet for us. Winnipeg's a little more modest in the rent increases, but still a stable area. And then, like I said, we've just broken into the Ottawa market, which is $11-12 rents now there with no real land expansion. And when we're talking small bay, nobody's really building those right now. I mean, it's just the costs and whatnot. So there's still room for rent growth there before it peaks, I think. So we're looking forward to another 2 or 3 years of this rent growth, I think, is what we're going to see in our small bay side. We have mid bay industrial across Canada as well, but just speaking to the small bay, that's what we're seeing.
Wonderful. And so, I mean, that's one of the things everybody's been touching on is, I think, you looking at development and, redevelopment intensification as really at this point, the way to drive revenue. And, Brian, what kind of rates of return across the portfolio are you looking at, and what kind of strategies are you kind of employing to get there?
Yeah, we're employing a strategy where we're turning over every rock. We look at every property, look at ways we can intensify every property. We've identified 3 million square feet or so that we can add to our portfolio over time. Much of that, close to half of that, is kind of in the works right now. Yield on cost. So yield on incremental cost is very high. We just finished one in Montreal, for example, that the end of the day, it's a building that we added 2 wings onto, about 250,000 square feet in total in 2 different additions. The first one is done, and the yield on cost was about 9%. So that is the reason it's so high, is because the land's already taken care of, so not accounted for. It'd still be high even if it was starting from scratch, because it's just efficient. But the incremental yield is quite high, so we're looking at every opportunity to do that. Replacement costs are so high that it certainly justifies adding where you can, adding state-of-the-art space in great locations. And in some cases, we are actually raising or demolishing buildings that are in great locations that are very old and less functional, and rebuilding new. We're doing that in Mississauga, and yields are strong even when you take the whole property and redevelop it, because replacement cost is so high, and land, very proximate land, is very unavailable in some of these tight markets. So that's pushed industrial space farther and farther out. Certainly functional functional space that's got high clear heights, large truck maneuvering area, is very functional. It's hard to find that close in. So in some cases, we're actually redeveloping.
Wonderful. And Samir, are you seeing the same sort of thing? I know you've talked to a little bit, pretty significant development pipeline in the U.S.
Yeah, I won't repeat what's been conveyed, but I will confirm it's consistent with our experience across all markets. And I can simply look at one small example with our Blaine 35 development in Greater Minneapolis. Phase 1 is completed, over 74% leased, and anticipate we will be fully leased shortly, well above pro forma rents when we started that development. Phase 2, we're just breaking ground. Costs are all locked in, but we're already 50% leased. And again, these are just simple examples. The demand that my peers here have commented on, we're seeing this major disconnect between what the capital markets are suggesting and what's happening on the ground. That demand is not only going to continue, but we will actually see some tailwinds because for those that need space in the next 6, 12, 18 months, today, anything insofar as new development activity, greenfield, et cetera, there's both the inflationary pressure, but you also have the added risk of extended timelines for new developments. Companies that need more space need it now or need it very soon. And they're going to look to, in my view, those that either have space available or those that have development activity well underway so that they can, in a certain manner or with certainty, have their needs met for that additional space requirement.
Perfect. And unless, AIP is certainly probably the most exposed to new development, just given its thesis. Can you talk a little bit to that kind of demand that you're seeing in terms of pre-leasing and how AIP is getting its development returns across its portfolio?
Yeah, on the demand side, the small bay tenant is the nature of the small bay tenant is when they need to move, they need to move in a very short period of time. They're not long-term thinkers. So we find on the developments that, usually coming up to 30 days of completion, you're 50% pre-leased in some cases. We also have cases that we're 90% before we go vertical. But within a matter of weeks of completion where the tenants know they can move in, we get to 100% pretty quickly. The development, like our light industrial flex on new development products, we don't have anything that's really under $14. It ranges from 14 to 16 triple net. And because they're a small bay and, the cross section of the different tenants, we're filling those units up fairly quickly across the portfolio. We're still on a development basis building at an 8 yield to cost, even in the market today.
Perfect. And then I guess looking with a more Canadian focus, Kelly, there is a lot of demand. There is a lot of supply, as everybody's been talking about on the development side. Is that going to be enough to cool the markets, or are we still looking at tightening markets? I mean, you're seeing headline $40 rents in Vancouver, and it's things that a lot of people for a lot of years would never have expected. What do you think?
Yeah, I think everything's got to be put in perspective. When you look at Canada, like everyone talks about Amazon, but Amazon just overexpanded to grab everything they can for what they thought was going to be continued COVID growth. So them giving back space in the United States has no bearing upon Canada. Them giving back space, those landlords are probably happy because they probably were locked into lower rental rates with minimal growth. So it's kind of a positive for what happened in the States. In Canada, when we're talking about new build, I think like 69% of it's all pre-leased that's coming online. That's going to dwindle away pretty quickly. And when we're talking about e-commerce growth, that's going to be exponential over the next 4 or 5 years. And we're effectively at, I think, nationally 1.5% vacancy right now. That's almost effective full vacant, like it is full. And so when you take that e-commerce growth, even if there is an economic slowdown, the tenants that are behind the ball in that e-commerce have to gear up. So when you talk about everything being pre-leased on the new development side, I think we're still really strong on the fundamentals. We're going to build. We have excess land in London. We're going to build 250,000 feet, probably 350,000, and it'll be leased like that. At the end of the day, the fundamentals are really strong. I don't think we're oversupplying at all. In fact, we're still probably undersupplying, especially in major markets, because it's difficult to develop. You know, land is scarce. Go look in Richmond. We're going to build 74,000 feet in Richmond. It's $8 to $10 million an acre for land there. So we're going to go for a variance to be able to build more. So I think at the end of the day, the fundamentals for the Canadian market are really strong. We're undersupplied for the e-commerce boom, the continued e-commerce boom that's coming.
Perfect. Teresa, maybe you can touch on, you know, what you're seeing in Europe in terms of that. It's obviously always been a tighter land market, in more mature in some ways as well, and more open to intensification or denser development in what you're seeing.
Yeah, so for us, we do have one development, and that's in Germany at this point in time. And that was just land that we've held, and a previous, Magna asset was on that land. So for that particular location, it made a lot of sense to, tear down the old building, and we've built a new, 300,000 square foot facility. So we're starting to see very strong demand for that. As far as you're right, there's a lot of older product. There's not land is scarce certainly in the markets that we're in, which is the Netherlands and Germany. Land is scarce. There's strong tenant demand. E-commerce is not as developed as it is in the UK, but strong. I mean, it's moving up. It's getting closer to 15 to 20% in the Netherlands and the German markets. Amazon is not a big presence, so it's not Amazon. So Amazon has some presence in Germany. They're not present at all in the Netherlands, but there are other e-commerce providers that take up that slack. But, should they turn their attention to Europe, then, things could really change. But at this point in time, e-commerce is, projected to grow similar to, what we saw in Canada in the last 5 years and the US. There's not a lot of functional modern distribution product in Europe. So there's definitely, opportunity to redevelop any assets if they're well located. And that's something that, we're certainly seeing. But at this point in time, very strong demand. And, the Netherlands too, the Netherlands has been on quite the trajectory, even from the Brexit events that began in 2021, where a number of retailers and businesses had to invest in Europe to avoid what became, customs taxes and VATs applied to product that used to be distributed out of the UK. So that alone, so for the last 2 years, on top of COVID pandemic, pressure on e-commerce, there's also been a huge demand just because of the Brexit move and investment into Europe. And certainly the Netherlands has been a, benefactor of that. And you can see that too with the Port of Rotterdam, the growth that they're projecting, and they're continuing to expand as they become the entry point into the Europe and from products from Asia and so forth. So we're seeing very, very strong demand. I think the fundamentals are just as strong as what you're seeing in the key markets in Canada, in Toronto, Montreal, and Vancouver.
Perfect. And I guess staying with you, that there are strong markets, and real estate's always a local market in terms of demand and everything else. But where are you seeing your expected growth, and what are the kind of the required rates of return that's driving that view to where you're looking to grow?
Well, again, we're focusing on what we think are the key. We're focusing on the Netherlands and Germany at this point in time. So we're starting, the rental growth in Europe has been slow to, certainly not like what we've seen in the US, but we're starting to see that now. So there's key distribution markets coming in from the port through the central we call it central of Netherlands and into Germany. So what we're starting to see is easily with 10 to 15% growth on rents relative to where they were last year. For us specifically, it's gonna just on the nature of our leases, we'll probably get at that within a couple of years. It's not going to be immediate. But we're starting to see the rates of return similar to what we've experienced in the U.S., and that's why we're going to remain focused on those key markets in the Netherlands and in Germany.
Perfect. And Samir, you've made Artis much more nimble and pivotable, I guess, to address the need to show change and show investors change and drive returns. Are you seeing, what kind of required returns are you seeing, and where are you going to look to make those returns?
Well, if things continue the way we are witnessing real time, quite frankly, I see the largest and most significant opportunities from an Artis standpoint, as I said earlier, in the public markets. I think that the discounts that we are seeing across the board with where the shares or units of all the entities represented here are trading, it is so inconsistent with what's happening on the ground across the markets, as again we've heard. And while there still will be development opportunities available that produce attractive unlevered yields on cost, I think again from a capital allocation standpoint, we're going to be hard pressed when we have the flexibility to buy back our own units or to invest in the units of some of our peers to justify doing something different from that.
Very interesting. I think certainly unique. I think, Brian, going back to kind of Europe, and it's a mature market, you've been in it a lot. What markets are you going towards? You're not buying Gord's REIT, but you're looking for a lot of places that you can drive revenue. So maybe it's, I think, something unique between you and Teresa at Granite is looking at multi-country portfolios. And can you just give a little talk about kind of your investment process of looking at that type of portfolio?
You bet. We share a lot of Teresa's thoughts on Germany and the Netherlands and the opportunity there. We've invested a lot there, and we'll look to do more because of the rent growth opportunity. Because of the lease structures and the market conditions there, it does take a little bit longer to get at the rent growth or the market rent growth, but what we see is a growing spread between in-place rents and market rents. So we see that continuing, and there's significant barriers to entry there. Some of them exist in North America, some don't, in terms of an example would be the permitting. Like a 24-hour permit is harder to get in Europe than it would be in the United States. So the use of the land and the permitting to build can be a significant barrier to entry, meaning we're seeing more and more rent growth before new supply comes on. So we love those markets. We've got great teams there on the ground. We'd like to continue to buy near the port of Rotterdam, near all over the Netherlands. Certainly the German markets that we're in and near those have performed very well. We do like the outlook in the United States. We will likely allocate more capital to the U.S. And then we'll continue a balanced approach in Canada as well. I mentioned we're doing a very significant development initiative in what we call the Greater Golden Horseshoe area, and we've already got some land secured and in development, and we're starting now, and we're looking to build a pipeline to continue to do development there because we see it as a great opportunity. Unless your development yields sound very, very attractive, but your in-place rents sound low. So you may be leaving something on the table there, because I think rents are going up. I mean, we've seen a $20 triple net per square foot rent in Montreal, and we're seeing high teens in distribution space. So certainly the small bay space is likely to be even higher than that, just because of the cost to replace are higher. So there's a lot of opportunities out there. It's very expensive, and we're very cautious on where we are looking. Capital is precious. So, I take Samir's point that the disconnect between public markets and private is grown significantly. One big difference is you can buy public market companies any day you want, any hour. For us, properties that are strategic, properties that are very, very well located in what we want and part of our overall strategy only come available so often. So we've got to have capital available when those do come available. to capitalize on it. So we, unlike kind of equity investors in markets where you can kind of buy and sell and trade on a moment's notice, we've got to have capital ready at any time to jump on land opportunities, just building acquisition opportunities, when they're available. So we're cautious with that. I'd say we're now coming into a time where we are re-underwriting everything before we waive conditions, making sure that it is exactly what we want and right on strategy, because the future is uncertain. So, but what we have seen is that the markets in strong markets, strong logistical markets, strong business centers, strong population centers, the values have changed very little. So the future is uncertain, but our company has been all industrial all the time. We've grown from a small company to over $6 billion of assets over the last 10 years, and most of that in the last 5. So we're not. This is not a timing play for us. This is a long-term investment in a sector that we think will be very healthy over the long term and through different economic cycles.
Perfect. And you kind of touched on markets. I know we've talked about European markets and, Rotterdam and Germany and the Netherlands in general, but going kind of pivoting back to the US, AIP is the only US only trust. It's in its declaration, it can't own any assets in Canada. So I think it's unique in the Canadian universe on that side, certainly on the industrial side. So what markets are you looking at and why?
We're looking at the growth and across the Sunbelt states. And, when we go into even the markets that we're in here in Dallas, the competing, call it product, mind you, it's older, it's 9 to call it $10.50 triple net. All the new stuff that we're bringing on in those markets are, 14, 16 and plus from that. We are so very heavy in Texas. Texas continues to grow. From Texas, it'll be Florida, Georgia, the Carolinas, mainly the Sunbelt states that continue to have a large influx of not only people, but also small businesses.
Perfect. And, Teresa, I think you're the only, certainly the only REIT here that has a US West Coast asset on the panel. Are you looking at that area, or is market dynamics just better in the Dallas, Memphis, Nashville, Columbus, the same way that you've got Brian, is heavy in those markets as well?
Yeah, that's right. We do have a Portland, Oregon asset. But really our focus has not been on the West Coast nor the East Coast. It really is the Midwest markets that are core, that really have become core distribution markets, where you have the distribution infrastructure of cargo airports and the ports. That's why we like Savannah and Houston and are in those markets, as well as rail. So it really is, for us, the focus is on Indianapolis, Memphis, Columbus, Cincinnati, really those core Midwest part, which have really, I think, has been the right investment in the last 5 years, certainly, because we've seen the growth trajectory there, and we'll continue to do so. And we like we did get into Chicago market this past 12 months. We like the Chicago market because it's a key Midwest market, and it's also a strong demand market, similar to like Dallas, where it's a strong demand market as well. So those are new to us, and even though we've tried Florida, we just haven't been successful there. So I think that's just, the pricing's just been too sharp. But no, our intention is to focus on the Midwest, where we are today.
And just to clarify, Rob, Portland is not technically coast.
That's right. It's not LA.
People think it is, but it's not. Yeah. We're certainly moving further west. As Samir knows, we've got a building in Denver and got a lot in Las Vegas. We're looking at some coastal markets. But Teresa, we're in all those same markets you are for rent growth, and really, really solid, kind of predictable returns in those markets.
Correct.
Brian, is there a reason why Canadian public investors never seem to go all the way to the West? Like, they love Vancouver, hottest market in the country in a lot of ways, but just have, either a fear or just, don't want to have exposure to those West Coast markets. And, you know, that is unique where you're starting to build in Vegas and that sort of thing.
Yeah, I think, well, in the Canadian West Coast, I think it's just a supply issue. That market is not that big. It's very, very expensive. It's hard to enter, hard to get any scale there. So I think it's been difficult for Canadian companies to gain any scale there. We've looked hard at it. We would like to have a Vancouver presence, but we're, like Teresa talked about in some of the US markets, having a difficult time entering it, but we're going to keep trying. We do service Vancouver from Alberta, from new developments there. So we're participating in that through that development. In the United States, we are looking at the West Coast. We're comfortable with the West Coast. You know, Les touched on some of the markets in the US that have thrived. Some of that is because of business climate. You look at Texas, and there are more businesses coming to Texas. There's more people coming to Texas, and it's not just a weather thing. This is because there's more jobs. There's a young, educated workforce. The business climate is great for businesses to grow. There's availability of labor. There's availability of land to grow. So those are great markets. I think, Les, where you are is one of the hottest places around, and probably will be for the foreseeable future. We like California from a fundamental standpoint. From a business climate, it's tougher. So it's a little bit harder to enter that market. However, the rent growth there is very high because the barriers to entry are very, very high.
Perfect. And then, you know, Kelly, you actually do have pretty good exposure into the West Coast, and, you know, you have to pick your places and pick your kind of unique ways of getting that exposure. So could you talk to that a little bit, and how you're kind of finding those niches that other people might be overlooking?
Yeah, well, West Coast, we really have one asset right now. We probably will be picking one up in Kelowna. But our asset's a little bit different. It was an industrial property that we've repurposed. And we were into that when we were diversified. And, you know, at one point we were looking at moving that property, but then you see skyrocketing land values. And so what I can build there, you know, we're looking at building 74,000 square feet. And you're talking, with the use that we're going to do, upwards of $40 a foot. So the return's phenomenal. And so we're at one point, I was looking at divesting of the asset. I think we're going to develop it. And we were actually going for a variance of another, I think, 500,000 square feet to be able to build on that location. So when you're talking $40 rents, that is a big number on development return. So that was a unique relationship we had with a developer on taking an asset and repurposing it. And so I think there'll be a few more with that developer going forward. But overall, from fundamentals of trying to move into Vancouver, the cap rates don't seem to be looking at interest rates at all. There's a lot of money changing, changing hands on sales there. So price per square foot is outrageous. Cap rates are extremely, extremely low, and they don't look like they're going to move at all. So the ability to actually head into that market, unless your cost of capital is next to nothing, it's going to be very difficult.
Perfect. And Gord, going all the way to the other coast, you know, that is something that it seems like the lower cost of capital players that are all, you know, often looking for trophies or have the ability to really drive down cap rates without, you know, much regard to, sometimes it seems like the returns, is different than what you're seeing on the East Coast when you're looking at a Halifax and everything else, where it seems like you can still get, you know, diamonds in the rough, and especially if you've got a local focus. Can you talk to that a little bit, and, you know, what you're kind of seeing there and what the return dynamics are?
Sure. I mean, there's lots of pension funds that have money in Halifax that are industrial wise. You know, some of the bigger REITs had real estate there. Dream Industrial certainly had a nice portfolio there, which we've been lucky to get a piece of on the way through. So that said, but we're seeing competitors in these markets. On their last bids, there was investors out of Ontario looking at that. There's certainly in the apartment space, there's lots of, if you will, non-Atlantic investment going into those areas. Moncton's a nice little niche for us. We've gathered a portfolio of 7 or 8 properties. They're kind of a one-offs, including, bought an empty building there last year, 80,000 square feet. That was a single tenant and single tenant owner occupied. And we had a view of just punching a couple of doors and we should be able to get a lease as multi-tenant. So we're very successful on that. So there's these little nuggets there that come across that are a little bit too small for some of the bigger players or that type of thing. So we try to capitalize on that when we can. That said, I think it's being noticed that the Halifax Atlantic market is strong and somewhat COVID protected. When we look back in 2020, it was good to have 40% of your assets in Atlantic Canada at that time, which we did. So, but there's lots of players around. The cost of debt there, I don't think you see as the premiums that you used to, 5 years ago. So we're still competitive with the debt there. So, but it's still a small market. So there's not that much around there. So, but for us, it's a good market, and we'd grow there if we could, for sure.
Perfect. Looking at kind of the 3 cross borders, that is, as Gord says, there's Canada's always been known as a lot of the great assets are held, and they're held by people that don't necessarily want to sell. The liquidity is never quite as high as it is in the US. What are your plans in terms of target exposure to Canada? Is that something you're trying to grow, or is it something that you'll hold steady and naturally kind of decrease as you grow elsewhere? Or is that something that you're looking to, take some money off the table? So I guess, Samir, on the direct side, as opposed to an equity investment side, are you looking to expand or contract?
No, we after we sold our 2.5 million square feet in the GTA last summer, from a Canadian perspective, that leaves us with 2.5 million square feet across approximately 37 assets. And that is largely Alberta and Manitoba, with a little bit in Saskatchewan. Manitoba, Greater Winnipeg is where the majority of that 2.5 million square feet is situated, 1.6 million square feet approximately, with 26 assets. So, again, in all those markets, we're just going to be patient, capitalize on the escalating rental rate environment, and we don't intend to increase our presence, nor do we have near-term plans to sell any of those assets.
And Teresa, the same sort of thing? Are you, it's easy to grow outside, it's hard to grow inside.
Mm-hmm. Yeah, no, we like obviously Canada, and really for Canada, it's the GTA for us, and now south, the Golden Horseshoe, as we've, acquired 92 acres of land in Brantford. So we like Canada. We typically longer term, it's roughly 20% of our revenue. It's down to 16% right now, but we do have this development, which is going to add a couple of million square feet. So we'd like to long term, our projection is to keep around 20%, but you're right, our growth really has been in the US, where the opportunities have been most attractive as far as an allocation of capital. And Europe, we like Europe to keep around 30% of our portfolio. But Canada, for sure, we like Toronto. It's just been really hard to grow in the GTA, as you know. So we think this opportunity in Brantford is really going to, hit it out of the ballpark. And so far, everything that we've seen, the interest that we've seen in this land that we've just acquired, I think it's going to be a great growth story for us in the GTA. And we'll continue to look for opportunities like that.
Is the GTA kind of becoming, there's the GTA now, there's like the greater Toronto area, and 5 years from now, is it going to be the greater, how far out do you really kind of expect that GTA Golden Horseshoe umbrella to keep expanding?
Yeah, well, right, you're right. Even a few years ago, it was really up to the green belt, and even Milton was viewed as being really, not really part of the GTA. But I think that that's really changed. I mean, obviously because of the inability to develop anything new or acquire within the actual 905 area, i.e. Brampton, Mississauga. It was really difficult to grow within those limits. So I think it is expanding, and there seems to be a lot of strong tenant demand too, with the likes of our Brantford location. We're seeing development obviously in Hamilton. Summit's been very successful, obviously, in Guelph, in the Guelph area. So it is expanding, and I think it's expanding because one, it needs to be. There needs to be, you know, the tenant demand is there, and there are certain tenants that are willing to be a little further out in order to get one, access to modern distribution product and warehousing, as well as, you know, obviously rents that work for them.
Kelly, are you seeing the same thing? I mean, are your London assets 10 years from now going to be, you know, the greater golden horseshoe?
Yeah, to be honest, I think it will. When I look at what's happened in London, right, you've seen rates that are going to double. So for the first time, and, you know, London used to sit at $4 to $5 forever, and now it's $9, $10, $11. And you know, when I look at that market, right, it's situated between Windsor and the GTA, really. And it probably, from a logistical standpoint, takes less time to drive from London to Mississauga than it does from Scarborough to Mississauga. So I think the attractiveness of it is there. And I think you're just going to continue to see that push, right? Woodstock, London, and as everything moves west. But again, like, land is scarce. London's hard to develop on new land. They're really restrictive on development. So they have a real manufacturing focus. So to try to do modern logistics there is a little tougher on new land. So, but I think just from where it's situated, you're going to see that grow straight down, I think, down the 401 as we continue to move on in the life cycle of the Canadian industrial.
And Brian, I'm assuming that you're an echo of the last two.
Certainly an echo of everybody's sentiments here. We've got close to 60% of our assets in Canada. It's likely to remain high, certainly more than 50%. As we grow, we're looking at a balanced approach. Certainly we're investing a lot in development, as I mentioned, and also buying strategic assets. We've been calling it the GGHA as well, the Greater Golden Horseshoe area. Whether that'll stick or not, I have no idea. And I do pity the person, Kelly, that's got to go from Scarborough to Mississauga, because that's about the worst drive you can do. So we think the flow of goods coming from Windsor, Detroit, up the 401 corridor, the 400 series of highways, whether it's Buffalo or Windsor, those are strategic. Those are strategic distribution corridors and trade corridors, and we want to be a part of that. We've done great in Cambridge. We've done great in Kitchener-Waterloo. And we feel like those markets are going to perform well. And to your point, Rob, will probably be considered part of this sprawling kind of GTA, although we have a tremendous amount of our portfolio that's very close in that we're very proud of and will continue to try to maximize value in. That's where we see the majority of our rent growth. So we've got a balanced approach of new development in that area, which will be state-of-the-art property, as well as enhancing value within our current properties that are much closer in.
Perfect. You know, and Samir's seen as it's a hugely expensive market, and he's taken money off the table. But by the sounds of it, next year he'll be here and will be an investor, and everybody else's REIT is sitting on this. So thank you all. You know, last thoughts. I guess we'll put it off to Samir, kind of as thoughts, you know, or anything that you're thinking of that we haven't touched?
No, I think this has been very comprehensive. I just want to, because of the audience we have participating today, I just want to really reinforce what many of us have commented on with respect to the disconnect between Main Street and Bay Street, or Main Street and Wall Street. We recently launched the sale of our Minneapolis industrial portfolio, 26 assets, 3.9 million square feet, not including our development site. And the volume of inbounds we have received from all the conventional players, but also from non-conventional participants across the spectrum of capital types or sources, it is it just reinforces what the demand is to own single or portfolio, a portfolio of assets within the industrial space. Again, despite what we're seeing on the interest rate side, we think this portfolio is going to sell for a record price, and we're going to have a lineup of bidders along the way. So I think it just reinforces the value that is represented around the table here with the entities and the assets they have with a focus on industrial.
And I think that's a great takeaway. The amount of capital at play, sitting on the sidelines, wanting to get exposure into the industrial market is always been massive, but I think is still at an all-time high. And it's there's very few ways to play it in Canada, and all the players are unique and have a really unique exposure to all investors, and there's huge capital waiting to sit there to get that. So whether it's public or private investing in it, there is a wall of capital sitting there, and everybody should be looking good. So thank you everybody so much. After lunch, we are back with Fred Blondeau and with our Canadian multi-residential panel.
Thanks very much.
Thank you.
Thank you.